Let's take a look at this intercompany transaction problem. It deals with Lemon Inc. and Foyer Inc. and there's an asset sale between these two related parties. Alright, here's what we know, and I'm just reading right here. Lemon Inc. owns 80% of Foyer Inc. Last year, Lemon sold equipment to Foyer, and here's what we know about the equipment. And here's what we know about everything, actually. Lemon owned it for 3 years. It originally purchased it for $75,000. It was depreciated using maker's depreciation for both book and tax purposes. That means, for some reason, the company decided that maker's was appropriate both for financial reporting purposes, according to GAAP, as well as for tax purposes. And $40,000 of it had already been depreciated on it. Okay. Lemon sold it to Foyer for $45,000, and we assume this took place in the last year. Foyer had profits of $55,000, including $1,000 of depreciation from the excess of the selling price to Foyer over the original cost of the equipment to a Lemon. So in other words, the $55,000 also included $1,000 of what I'll call excess depreciation, because if these parties are related, then that excess amount of depreciation needs to be eliminated. We need to show on a consolidated basis the equipment at cost. Alright, so the first question is, what's the gain that Lemon should record on the sale of the equipment to Foyer? Alright, now I worked this ahead of time, so let me just bring it to life for you. Okay, so the equipment at cost was $75,000. The accumulated depreciation was $40,000. That way, if I highlight this and bring it to light, we can calculate that the book value at the time of sale was $35,000. Now, we had a sale to Foyer at $45,000, right? All of these numbers are just simply given. And that way we know that there was a gain on sale of equipment of $10,000. Okay, so $10,000 is how we answer question 1. Now, question 2 says, provide the journal entry that Lemon should record related to the sale of the asset. Alright, again, I worked this ahead of time. Well, for proceeds, we're going to assume that it was cash because they don't tell us anything else. Now, it could have been a receivable. It could have been an intercompany account. Right? I mean, we've got two separate companies. If they were owned at this point, rather than settling up with a cash, they can settle up with an intercompany account, which essentially is an accounts receivable, but the accounts receivable doesn't ever have to actually get settled. If you think about it, you know, you've got if you got two companies and you're settling cash between left and the right, think of it as pockets. It's all one and the same company. You're just moving cash from one pocket to the other, so why bother? And the one way around that is to just use intercompany accounts, which are like receivable accounts. But given that they didn't say that's the case, we'll assume that cash was the proceeds, and cash of $45,000 was received. Now, in addition to cash of $45,000, we had two other transactions. We had accumulated depreciation of $40,000 given right there. That has to be removed from the books, and the equipment is removed. So that's the entry that Lemon has to record. Now, I want to slide down and tackle this third question. Third question says, provide the journal entry that Foyer should make to record the purchase. Okay, well, Foyer records the equipment at its cost, and its cost is $45,000, the sales price. Alright, then it pays cash. That's all there is. Oh, and I don't have that formatted correctly. Let me format that for you, and we're good to go. Okay, then we get the next question. Alright, now I've slid up a little bit so we can see that question. Question 4 is, provide the consolidated worksheet entry, or these are actually entries that would need to be made. Let me change that. That would need to be made at the end of the reporting year related to the transaction. So in other words, we've got two separate set of books. what's the entry we have to make on our consolidated worksheet so that when we combine them, we're not overstating the equipment, overstating depreciation. In other words, we need to make sure that from a consolidated basis, we're really only recording the equipment at cost. We've eliminated any gains, and we're recording the correct asset values, investment values, and income. All right. Well, let's start us off here. Bring this to light. All right. Now they said that the subsidiary recorded $55,000 of income. Now I'll slide up and show that to you. Right. Foyer had profits of $55,000, and Lemon owns Foyer, so Foyer's the subsidiary. It included $1,000 of depreciation on the excess of the selling price over the original cost of that equipment that was sold on an intercompany basis. All right, so what else do we know? Well, we know that the income from the subsidiary has to be debited, right? We're going to consolidate the income, so the fact that there was a income from subsidiary recorded using the equity method on the parent's books, that has to be eliminated. We debit $55,000 to eliminate that income that they've been reporting, and we credit investment in Foyer for 80% of the value. Why 80%? Because Foyer Lemon only owns 80% of it. That means that there is a non-controlling interest share of income that needs to be recognized for the other 20%. Okay, now, why do we make that entry? Well, you might want to note this in your entries, but I just wanted to put it here so it's clear. This is the entry to record the elimination of the subsidiary income and investments as part of preparing consolidated financial statements. Now, that takes care of the investment in Foyer, as well as the elimination of the income from the subsidiary and recognize of the interest share of the income. But we still need to worry about that equipment, right? Well, here's what we know. Let's bring this all to light here. We know there was a gain on the sale of equipment of $10,000. Now we calculate it there. We need to eliminate the gain, so we debit it, and we need to also make a couple credits. We need to credit that excess of the $1,000 of depreciation expense because that's like phantom depreciation expense. It's being recorded on a cost basis that didn't really exist. The real cost basis was what the first company purchased it for, the first company being the Lemon Company. Okay, and then the equipment, the difference between the markup, that $10,000 markup, and the $1,000 of depreciation, all of that needs to be eliminated because we marked it up essentially because we treated it like a sale to an outside party, but for consolidated purposes, we simply moved it. So we need to eliminate that phantom cost there. And to do that, then we would just jot the reason for it, to eliminate the gain from the consolidated results of the organization as well as the markup of the equipment still being used and the depreciation expense above, right? All of that is recorded. And that takes care of how you would answer these 4 questions related to this scenario. Thanks, everyone.